Okay, good morning, folks. It's always difficult to know exactly when to start with these proceedings. On our side, we see the participant numbers kicking up, and once we had a few hundred, we always think it's courteous to start at the starting time, but people inevitably join a little bit afterwards. My name is Peter Armitage. I'm the Chief Executive and Co-Chief Investment Officer of Anchor, and we've got a very interesting topic today. So the gentleman on my left, I'm not sure if he's on your left or your right, is called James Bennett. James and I have known each other for many years. We nearly worked together about 20 years ago at UBS. And James is one of the most celebrated analysts in the South African market. He worked for UBS. He was part of some global teams that they did. He was a top-rated analyst for many years. And it was a great privilege when about a year ago, we met up with him and he agreed to help us on the equity investment side. James is well-versed in the resource sector, technology sector, and he's been focusing and working with our business to add, I think he's added a huge amount of value on the technology side. Some of the shares in our global portfolios are as a result of the many years of effort and time he's put into analyzing them. And I think he's, of the highest quality out there. So it's a privilege to have him as part of our team. Now, James, obviously the EV sector, and Tesla in particular, is probably the most talked about and researched company in the world, I would imagine, probably besides Apple. And we don't have exposure to Tesla. I think at times that's been good, at times that's been bad. But we asked James to do a deep dive into the sector and assess EV as an investment opportunity. In Anchor, we are growth orientated, and we always want to make sure that we've got exposure to the changes in trends where our clients can profit out of that. So James did two internal presentations, one on Tesla specifically and one on EVs, which were of such high quality. I insisted that we use it and share the information, knowledge, and insights with a broader audience. So it's quite specific. Normally we do more general market-related presentations, but judging on the response, where we've got a few hundred people, I think we're up to well over 300 people attending already on this call. There's clearly a lot of interest. So thank you for sharing a bit of your time with us. This is all about James and not about me. So I'll hand over to him. Please feel free to put questions in the chat. At the bottom, you'll have a Q&A and a chat. Sorry, the Q&A is more suitable if you want to ask some questions. And then after James is finished, I think he'll be about 35, 40 minutes. And we'll cover some of the questions in the Q&A. So over to you, James.
Great. Thanks very much, Pete. Does that come up clearly there, Pete?
Yeah, that's perfect.
Okay, yeah. Excellent. Great. Thanks, guys. Thank you very much for your time. So let's get into the EV discussion. So a couple of things I just wanted to mention up front. Just two acronyms that I'm going to be using quite a lot. The first one is just EV, which just stands for electric vehicle. I'm sure everyone is aware of that. And then the other one that people use is ICE, which stands for internal combustion engine. So rather than saying all of those words over and over again, it's easier just to use the acronyms. So EV is just the electric car. ICE is basically the petrol and diesel cars that we've all been driving around up until now. So you'll hear me using those terms quite a bit. So there's also just two sort of separate things that we need to think about. There's the theme of EVs. And then there's a very sort of almost separate question of, is Tesla a buy or not? And what we do know from history is that good themes don't always make good investments. The airline industry is a good example of that. It's been great for consumers, people being able to travel the world. It's opened up industries like tourism and that, but the actual airlines themselves haven't been particularly profitable over time. So just because one might be a believer in EVs doesn't automatically mean that the Tesla share is a buy. There's things like valuations, competition, profitability, and that sort of thing that come into that as well. I think just on the EV themselves, we can say with a pretty high degree of certainty that this trend is underway. I think in our lifetimes, most of us will probably own at least one EV. And, in the future, I think, we're pretty certain that that's underway. Tesla itself as a buy is a little bit more sort of controversial, partly because of the high valuations that it trades on. And it's a share that's got a very sort of futuristic component built into it as well. And these sort of futuristic things that you can't really capture on a spreadsheet. So, we would say valuation rigor is extremely important. You should never buy a company until you've at least tried to sort of, do some valuation work on it. But there's a lot of Tesla that you can't just capture in a conventional spreadsheet. And as such, it pretty much keeps the market divided. Sort of the investment houses out there are classically split between the value and the growth funds. I think you'd be very hard pressed to find a value fund manager that owns Tesla at the moment. And even within the growth camp, I would say the market's sort of fairly split between, even the growth guys saying, well, I'm looking for growth. Yes, Tesla's got that, but the share's too expensive, versus the Tesla bulls out there who believe that this will one day be the largest market capitalization company in the world. Obviously, Apple is the one that's got that mantra at the moment. So that really just sets the scenes for what we're going to be talking about today. Okay, so if we just look at Tesla, I mean, it's a share that really divides opinions, as I said up front. And there's really sort of three key things that we think we should be thinking about with EVs in Tesla. The first one that's very important that I'm going to talk about is that we can't think about these EV manufacturers in the same way we've thought about the ICE manufacturers. It's not just going to be a simple case of ripping the engine out of your existing cars, sticking a motor and a battery in, and away you go. There you've got your EV, BMW or Mercedes. It's going to be a very different market, and therefore investing in the sector is going to be very different as well. The second thing on Tesla is that it's probably already a much better company than most people think it is. 5 years ago, it was one of the most shorted shares out there. They had debt. Everybody just thought that Elon Musk was blowing a lot of hot air, that nothing was ever really going to happen. But I think that's really changed. And I think that's where probably the bears on Tesla have really got it wrong, that this has actually emerged as a pretty strong company. And then the third thing that we're going to talk about today is that this Tesla share does have a very sort of futuristic component built into it. There's a lot of areas, but especially the one around autonomy. And that's, as the world moves towards autonomous driving, where you don't actually need a driver anymore. And that's why it does make it quite a difficult stock to really, put into a very conservative private client portfolio. But it is a company that we need to follow. It's something we need to be aware of. And perhaps in the course of time, there will be some opportunities in the share. Just a couple of metrics on Tesla, and it's the thing I'll say here is that it's really just become too big to ignore. A near $600 billion market cap, and in fact, at its peak a year ago, 18 months ago, it had over $1 trillion market cap. It's the seventh biggest company in the S&P 500 index, and companies don't get to that sort of position by being a complete load of hot air. There's got to be something of substance behind it to get to that kind of size. Obviously, what keeps us all awake at night are those sort of 50 type of PEs. And that's the pushback you get, especially from the value guys. They say, great, idea, great theme, but, is the stock just too expensive? Okay, so on the first section, I said we'll be talking about comparing EV versus ICE. And this is just really the point that it's going to be a very, very different market. Now, here's kind of a table comparing the pros and cons of EV versus ICE. And I don't think anybody can say that an EV vehicle is simply better than an ICE in every respect. There are some valid concerns around EV, issues that aren't just, going to go away. There is a bit of a trade-off, but I strongly feel that on balance, especially for around town driving, an EV is a much better outcome, than an ICE. one can run through all of these things. I'm not going to go through all of them, but I will address some of them sort of in the subsequent slides. And this is just sort of a key point again on why we need to view these EV manufacturers differently from the traditional ICE things. The thing about an EV is that it's completely soulless compared to an ICE. So, the ICE market is lots of small manufacturers. Buying an ICE is a very sort of emotive purchase. People get into heated debates about why they prefer a BMW to a Mercedes, to a Volvo, to a Toyota. This is a lot less applicable in an EV world. An EV is a much more sort of homogenized product than an ICE. So if we look at some of the factors that are very common across EVs, they're all extremely quiet. It's like driving on a magic carpet. They're all very efficient. They all have very low maintenance, and they are all ridiculously fast. So in an EV world, that sort of 0 to 100 kilometers in 3 seconds was really only in the supercar world, in the ICE world, just becomes completely commoditized. Even a slow EV goes from 0 to 100 in 4, 5, or 6 seconds. So they are ridiculously fast. And for example, if you ask a guy why he likes a Toyota, he'll say, well, it's the most reliable car on earth. The reality is that the least reliable commercially sold EV will be more reliable than any Toyota you can buy today. So it's kind of just, they're all the same. And, the one brand just kind of feels exactly like the next. And so what you're likely to find is that the number of manufacturers is going to shrink over time. So you're going to have a small number, kind of like we've seen with, the iPhone and Samsung. It's going to be a small number of large winners, of which Tesla is no doubt absolutely at the forefront. And really, the differentiator between EVs becomes more about software and about the upfront price as well. And that's where Tesla have been amazing, where their sort of production progress has really revolutionized the way cars are actually built. I'll talk a little bit about that as well. And they are absolutely at the forefront when it comes to, the software in EVs. Just one little slide of an anecdote that I'm going to throw in here. So a hobby that I've had for over the last 10 years is I fly these electric radio-controlled helicopters. And what really revolutionized this hobby was when the lithium batteries came into sort of scale commercial production about 10 years ago. Up until then, all of these helis were driven or flown by sort of nitro or petrol, I guess, as we could draw the analogy with cars. Back then, nitro had about 95% market share. Electric was 5% market share. Fast forward 10 years, electric has 95% market share, and nitro has about 5% market share. So the electrics have completely killed sort of the fuel, nitro, petrol type of market. What it has done is that it's given me a lot of experience with these lithium batteries, and everything that applies here applies exactly into the EV cars that we know today. And if anybody's thinking about buying an EV going forward, it's quite important, I think, to understand the rules around these lithium batteries. So one of the things about lithium batteries is you should never, ever charge them above 100%. When you do that, that's when most of your fires actually occur. And that's why when you look at the EV market, when they give that fast charge rate, they always cut it off at 80%. They'll say you can charge this car to 80% in 45 minutes. Because once you go above 80%, you've got to start tapering that charge rate off pretty dramatically. And when you get to about 95%, you're pretty much sitting at a trickle charge there as well. Some of the other rules around lithium batteries, you should never store them fully charged. At least for more than a few days, they start to swell. And that's why, sort of in buzzing around town every day, best practice for these things, these EVs, would be to not always go with a full charge, but maybe just go to 80 or 90%, unless you are planning a slightly longer journey. One of the other absolutely golden rules with lithium batteries is to never discharge below 20%. I mean, one deep over discharge can literally ruin a pack instantly. And why that's important for the EV market is that there's this sort of slight controversy about how some of the EV manufacturers state the capacity of the batteries in the car, whether they're giving you the gross 100% capacity or the net 80% usable capacity. I think, that's probably starting to correct itself now. And generally, the manufacturers are giving you the capacity, the 80% capacity that is actually available to you as well. One of the things that does keep me awake at night with these lithium batteries is the fire risk. There has been some incidents where these cars have crashed and burst into flames. That picture that I show on the top left there is basically a hobby-grade lithium battery that's caught alight, and it will burn like that for about 5 minutes. It is absolutely frightening when these things go ablaze. And a lithium fire is a thermal runaway. So if you come at it with a fire extinguisher, all you're really doing is putting out what's burning around the battery itself. The actual battery itself is very hard to put out, and it will continue to burn until that energy in the battery has burnt out. The other sort of key point before I move on this about lithium batteries is that your typical lithium battery loses about 4 to 10% of its storage capacity every year. A lot depends, how you treat it. Are you discharging it very aggressively? Are you always leaving it fully charged? But if you think of sort of a 5 to 7 year view on owning an EV, by the time you get to that 7 or 8 year mark, you've probably lost, 20, 30% of your capacity. And most of these manufacturers are selling their EVs with about an 8-year warranty on the battery. And at that point, you are probably likely to see some degradation in your travel distance. Now, this slide here is one of the most compelling and perhaps less understood factors about driving an EV versus an ICE. And that is that an EV is significantly more energy efficient than an ICE. And, different studies will show slightly different numbers, but I think broadly these are good ballpark figures. And the argument is that when you drive an EV, you are converting about 70 to 90% of the contained energy in the batteries into go forward energy, whereas with an ICE, you're only converting about 30%. So an ICE is a very inefficient way of taking energy and converting it into go forward energy. And a lot of what's lost with an ICE is in heat. The huge heat that an engine gives off is basically just wasted energy. And then the drivetrains are way more complex in an ICE than an EV. You've got gearboxes, you've got the big drive shaft in a four-wheel drive that goes between the front and the back of a car. Whereas with an EV, you basically just bolting an electric motor that gives off a little bit of heat, but not much, almost straight onto the wheels. So there's no drivetrain. And then the other thing that's very compelling with an EV is what's called regenerative braking. And that's why with an EV, your range around town is actually rated higher than your country driving, unlike an ICE where it's actually the other way around. We know you get a longer range in country driving than you do around town. I'll come back a little bit to that regenerative braking just now, but there is just this factor that when you start driving, you are able to, when you brake, putting a little bit of energy by the wheels actually charging back into the motor as you slow down. So when you drive an EV, you don't actually use the brake much. You just pretty much use your right foot. As you slow down, you just back your foot off of the accelerator. You actually feel the vehicle starting to slow down. And as a result, your brake pads also last incredibly long as well. So if it's true, as this chart suggests, that an EV is by an order of magnitude a more efficient transfer of energy, then surely driving an EV around town is going to be a lot cheaper than driving an ICE. And that's certainly the case, and I'm going to come back to those numbers. So Tesla themselves say that if you go from the oil well to the wheel, they believe an electric vehicle is about 4 times more energy efficient than driving an ICE. And certainly my sort of, numbers suggest that that is pretty much the case. And that's why, Tesla has this little mantra where they say, a Tesla is faster than a Porsche, but it's more efficient than even a hybrid, like, the early Toyota Priuses. So when people look at EVs and they compare them with the ICE, there's something called the TCO, or the total cost of ownership. Now, as always with these things, there's an element of subjectivity in how we measure these things. But just using sort of broad numbers, the argument is that the total cost of ownership of owning an EV is quite a lot lower than owning an ICE. Now, and it's very important to understand this first point. The one thing that is currently against the EVs is that your upfront purchase price is quite a bit higher than an ICE. 20, 30%, depending on the vehicle, but they are significantly cheaper to run, and they are significantly cheaper to maintain. So, it would seem that the energy cost per kilometer of running an EV is only about a quarter of running an ICE or petrol car, and your servicing costs are probably only about a third. There's no oil changes, your brake pads last just about forever. There's just way less parts and moving parts. And that's, why I say that Tesla and the others as well give you that 8-year warranty. There does then come a question mark with EVs at the end when it comes to resale value. Are these things going to be like iPhones where basically you just throw them away, towards the end of their lives? They're almost worthless. And just the number I show there is that currently it would seem that you would pay about 280,000 Rand to replace the battery at the end. So the running costs are compelling, the servicing costs are compelling. You do pay more, and because you pay more, and because the resale value is uncertain at the end, that does worry people a little bit, is that at the end of the day, is this thing going to be almost unsaleable unless you're willing to go and spend quite a lot of money on actually replacing the battery. So that's why one of the keys to unlocking the future of this EV market is getting the upfront price down. And that's why we've seen Tesla cut their prices quite a bit, but I'll come back to that on a later slide. Now, this is a study, and it's not the only study out there, that the Nickel Institute has done, looking at the total cost of ownership of an EV versus an ICE. And if you just look at the commentary there on the bottom left-hand corner of that slide, you can see there's many factors that go into it. What you pay for it, the subsidies, buying a wall charger, fuel prices versus electricity rates, maintenance costs, and then the resale value as well. Also, how much you drive. Obviously, because the running cost of an EV is so much lower than an ICE, if you're somebody who's driving a lot around town every day, the economics under that scenario come more favorably in favor of an EV versus an ICE. And also, if you intend to own the car longer as well, then you've got a longer period of time to sort of amortize that higher upfront cost with a lower running cost with an EV over time. So what this chart is LM means low mileage, owned for 3 years. HM means high mileage, owned for 3 years. LM7 is low mileage for 7 years of ownership. HM, high mileage for 7 years of ownership. So for small and medium EVs, your total cost of ownership, including the higher upfront price, is significantly lower for an EV than for an ICE. On the right-hand side, it's a little bit more controversial on the luxury side of things. And that is just because the premium that you pay at the moment for a luxury EV is quite a bit, higher than for small and medium cars. Obviously, it's a bigger amount of money that you have to try and recapture with a much lower running price. So the key to the continued uptake of EVs is going to be lower upfront prices. Now, if we just go into some of the specifics of owning an EV, so I'm just going to give a quick EV charging 101 here. So when you read about EVs, you'll see there's a lot of talk about level 1, level 2, and level 3 charging. Okay, so a level 1 charger is the cheap and nasty, the either comes with the car or you buy it over the counter. And that's something you can just plug straight into a general wall socket. That only charges at about 2 kilowatts. And just sort of, anecdotally, that's the equivalent to boiling a kettle continuously. Now, bear in mind in South Africa that we run at 220 volts. Your typical wall plug is rated at 10 or 15 amps. So you can really only pull about 3 kilowatts safely, continuously, without tripping your DV board. But, 2 kilowatts is such a slow charge rate that that's not really viable. The real secret sauce of EV charging is the home wall charger or a level 2 charger. So that's about 7 kilowatts. That's the same as running a large oven on full heat continuously, and you do need an electrician to fit this. You pay about 20 to 40,000 Rand for these. But what some of the South African manufacturers are doing, and I don't think this is the case globally, but because we have, a very high level of maintenance contracts when you buy a car in South Africa, and obviously these manufacturers realize that these maintenance contracts now are worth a whole lot less to the consumer for an EV. They actually include a wall charger in the price of the vehicle. So already that's 20 to 40,000 Rand that you don't have to pay there. And that charges at about 7 kilowatts. Now that kind of gives you an overnight charge. And to me, that's like charging an iPhone. You come home one night a week, as you park in the garage at 6 o'clock, you plug this in. When you leave for work the next day, you just unplug it. And that is your, 400 kilometers for driving around town for the next week. Maybe there's another night where you just do a quicker top-up charge as well. And then you get the level 3 public charging stations. And this is not so important for the round the town driving, because remember, as we show there, level 2, in the US, 80 to 90% of all charging is done at home. And that's really the secret sauce for around town. Then you get these level 3 public charging stations. And, these can charge at huge rates, but they are more expensive as well, because these guys have to make a profit. And that's where you sit and have your cup of coffee for 45 minutes and do a quick charge to 80%. That becomes more relevant in an emergency and on, obviously on longer journeys as well. So what I just show in this table here is that looking at sort of a small, medium, and larger capacity EV is, how long does it take in hours to actually charge with a level 1, 2, and 3 chargers. So a level 1 charger is really dead in the water. Sitting at home, that's going to take you probably the whole weekend to charge it. The level 2, you're probably sitting at about 10 or 11 hours, and really that's the overnight charge with the wall charger. And then level 3, that's sitting when you're driving a little bit further out of town, and you sit for an hour and you do the top up at the fast charge station. One of the questions that people ask then is, well, what about domestic solar? Is this potentially a solution for somebody who owns, let's say, just one EV? And I would say it's pretty tight. I think the bottom line with this is that if you already own a high-powered, off-the-grid solar solution at home, it's viable that you can do some charging of your EV directly off of solar, but it's really got to be sort of a heavy-duty, 20-panel solution plus. But it's not worth the economics of actually going and fitting a solar solution just so that you can charge your EV. So what I show there is to get the equivalent sort of level 2 type of 7 kilowatt wall charger going just off of solar would probably require at least 18 400-watt panels under perfect sunlight conditions. So if you already had one of these systems fitted at home and you're willing to charge directly off of solar in the middle of the day, you could maybe plug your car in on Saturday and Sunday over the weekend if you weren't driving it. And by Monday morning, you could pretty much have a free charge for 400 kilometers of driving. So it's a help, but it's by no means worth doing it just so that you can drive an EV for free. If we look at the cost of just charging electricity in South Africa, So on average, including that, we're paying about R2.50 per kilowatt hour right now. We are obviously, a lot more expensive than these heavily subsidized, oil nations. But then we are actually still a bit cheaper than, let's say, Europe, for example. Bearing in mind that if you look at a company like Grid Cars in South Africa that have got over 350 charge points, they're charging about R5.88 per kilowatt hour. So you are paying about double what the average household is actually paying. So just to look at the economics very simply, the average EV has about an 80 kilowatt battery. So if you do a level 2 charge at your home overnight, you're only paying about R200 to take your car from empty to full, to give you about a 400-kilometer driving. But if you do want the fast charge when you're on the road, you are going to pay about R470 for that charge. So this probably one of my most important slides would be this one to say, well, what then is your running cost in rands per kilometer? So if you are lucky enough to have a solar system at home, you've already installed it, you want to be off the grid with Eskom, for you it's already a sunk cost. Under good sunlight conditions, you could maybe even get your driving for free. But sort of the real key there is the level 2 home charging going for Eskom. As at current electricity rates, you're only paying about 40 cents per kilometer. And even if you're out on the road and you're going with a fast, Grid Cars charging station, you're paying just under R1 a kilometer. Whereas driving an ICE, a small ICE is kind of a little Toyota, medium ICE is an X3, sort of Volvo XC60 size. A large ICE is probably like a Toyota Prado, and a very large ICE is maybe a big gas guzzling Range Rover. You're probably paying 2, 3, maybe even up to R4 a kilometer, depending on driving conditions. So the running costs of an EV with the Eskom tariffs charging at home is hugely compelling versus driving an internal combustion car. Obviously, there's a lot of range anxiety with owning an EV, and I'm not going to say that range anxiety is completely unfounded. What the US numbers actually show, if you look at that bottom right-hand chart, is that just statistically, only about 5% of all journeys driven in the US are over 50 kilometers. So although range anxiety is for real, especially if you're somebody who travels a lot over town, for the vast majority of people, it's actually not a factor. But obviously, to address this, companies like Tesla do need to build these fast charging stations, which they have recently started to open up to non-Tesla drivers as well. So, there's obviously a bit of a network effect there as well. But you can see that over time, Tesla will be building and hugely stretching out its current sort of, 40,000, connector points to probably over 300,000, using the Morgan Stanley forecasts by the turn of this decade. And it's not going to be a sort of a huge money spinner for them, but it is part of the network effect. And certainly by 2030, they could be getting about $10 billion just in sort of electricity sales at these fast charging stations. Just looking sort of anecdotally, in South Africa, and it is a little bit sort of, controversial how you measure this, but your typical EV here is probably at about a 20 to 35% premium of the equivalent ICE vehicle. If we just do a straight conversion of what a Tesla costs in the US into rands in South Africa, bearing in mind that we would probably pay a bit of an import premium here, you're paying about R1 million for the cheapest Tesla to about R2 million. So, they're not cheap. Even the lowest car is not, R500,000. Even the little Volvo XC40 single motor EV is about 1.07, maybe 1.1, million rand. So we really do need some cheaper cars to come in here. And in fact, in the survey that they've actually done in South Africa, people have actually said that the major stumbling block for them why they're not owning an EV is not the running cost. Obviously, that's low. It's not even range anxiety because people are happy to own one to drive around town. It's really the fact that there just isn't a cheaper entry-level vehicle, into EV at the moment. And Morgan Stanley have, done quite a bit of work on this whole sort of pricing thing as well. And really what they're saying is that, this is a 1 in 100-year event that the world is actually facing with EVs right now. And, initially when the Model T Fords came in back in the money back then, they were quite expensive. There were lots of small manufacturers all trying to get in on the bandwagon. Obviously, many of them went bust. We think a similar thing could happen with, a lot of the conventional ICE manufacturers who are all trying to transition across to EVs. They're all talking a good game. I think a lot of them probably won't transition successfully over time. But also what happened back then is prices came down quite a bit too. And, Tesla obviously realized this and is why they've been actually reducing, their prices as well for two reasons, really, to drive out the competition. They've got the mass scale, they've got the margins, and they've already halved the ASP or average selling price over the last 5 years from over $100,000 to about $50,000. And yeah, it's pretty crucial that these average prices continue to come down. Just one other fascinating thing with Tesla as well is that unlike the other conventional manufacturers, they've historically spent absolutely nothing on advertising. And slightly tongue-in-cheek, Elon Musk used to say that, well, he got all of his advertising for free on Twitter. Obviously, with him having bought it now, that's probably a little bit less true. But yeah, Tesla, it's a little bit like an iPhone. It's not something that you really need to aggressively advertise. It's got a very wide brand recognition, and it does kind of, sell itself. So that's the first section, just, showing why the EV market is going to be very different from the ICE market. And I do think that a lot of the conventional manufacturers, they're all talking the good game about transitioning across to EV, but it's a very, very different mindset. And I think a lot of them, similar to what we saw with, Nokia and BlackBerry in the smartphones, are going to struggle to transition. The second section we said is that Tesla, coming back to Tesla, is already probably a much better company than people actually realize. This is not the hot air stock of 5 years ago. So to put it into perspective, just looking at their revenue, I think we can say with a fair degree of certainty that Tesla will probably be up at about $100 billion of revenue by the end of 2023. And just to put it into perspective, in a short space of time, they're already within the ballpark of companies like GM and Ford, auto manufacturers that have been around for decades. They're already getting up into the ballpark there of the Apples and Alphabets of the world. So this is a proper business that we do actually need to keep taking note of. One of the pushbacks you see from maybe the more value houses on Tesla is that they will say that this is an auto manufacturer masquerading as a tech stock and therefore has achieved a tech stock type of valuation. Well, the truth on Tesla is that you can call it what you want, call it an auto manufacturer, call it a tech company. The reality is that it's grown like a tech business over the last decade. So just the simple arithmetic average, it's averaged revenue growth of 53% per annum over the last decade, which is a phenomenal outcome. So far, the market has actually been correct in valuing this company the way it has. And if you just look on the right-hand chart, Tesla's revenue growth versus the S&P 500 in aggregate, and then the global auto industry on the gray line, it's been growing at an absolute order of magnitude bigger than the auto industry. So up until now, there's a very good justification why the auto manufacturers, the conventional guys, are trading on typically single-digit PEs, and Tesla's been on 50 PE. And then again, just looking at its production growth over the last sort of 8 years or so has averaged 64% per annum. Obviously, just with the law of large numbers, those percentage growth rates will start to come, down a little bit over time. But, there still seems to be a very long runway in front of these guys. And if we look at the overall sort of EV market, now, ARC Innovations is a, sort of a very high risk, high beta tech fund that I'm sure many of you are aware of. They tended to have been at sort of the higher end of optimism on these kind of things. And they sort of 5 years ago were saying they thought the global EV market would be 17 million vehicles by 2022. Obviously, COVID did get thrown in there as well. And in the end, they were too high. So the actual number was only 8 million vehicles, but that 8 million was still 4 times higher than what consensus had believed it would be in 2022. So, this is a market that, yes, maybe it's been a little bit slower than the absolute, raging optimist arguments out there, but it still has been grown way, way quicker than what the consensus has believed out there. If we look at Tesla's global, now this is the total vehicle market share with EV and ICE combined. I mean, it's still very, very small. And we did see now that in Q1 23, they released their results, just their production numbers recently. The financial results come out this evening. They had actually got close to 5% of the total market in the first quarter of this year. Now, the argument here is that if this EV market is going to be very different, as I said earlier, a small number of large manufacturers, we all accept that Tesla is at the forefront of manufacturing capability in EVs and the software that goes with it as well. It's not inconceivable to say that in 10 or 15 years' time, that Tesla could have maybe 20% of the total global vehicle market, which would mean another sort of, tenfold increase in their current production. And that's really the bull market, why Tesla is trading at the type of multiple that it is at the moment. Another slide, just courtesy of some of the ARC innovation numbers that they put out recently, and it does show that the ICE market is definitely in secular and terminal decline, and off a low base, the EV market is growing very, very rapidly at the moment. It really is about picking, who the winners are going to be, and just sort of, accepting that that's probably going to be a much more consolidated market than the ICE market. And again, just continuing with this theme that Tesla is probably already a much better company, than people actually think it is just if you look at their profit margins per vehicle is way higher than all of these other guys who've been doing it for decades and decades. They will say that they've got best practice down pat. And yet, Tesla have come in and already have been way more profitable than these guys with their decades of experience. And again, just looking at Tesla, the business, yes, 5 years ago, it was losing money. People were saying it was really just an arbitrage on the tax EV credits that they get. But actually, in the last 3 to 4 years, their margins are decent. They, again, looking at the right-hand chart, they now actually are more profitable than the average S&P 500 company out there, and certainly way more profitable than the average conventional ICE manufacturer, and even free cash flow. They were burning cash a few years ago. Now, the last 3 to 4 years, they've become, decently free cash flow positive, not up there with some of the software companies, but still, a decently a positive. And then even the balance sheet has improved as well. All the concerns about their debt 5 years ago when it wasn't that well rated, and a lot of hedge funds were shorting this share, that's just no longer valid anymore with a decent net cash balance sheet. And actually, if you want to call them just an auto manufacturer, actually a pretty solid, return on capital employed of, 20, 25, 30% over the last couple of years. Okay, then the third and final part of this presentation is the sort of futuristic component around Tesla. And I think everybody struggles with this. It's just things that you can't really capture on a conventional valuation spreadsheet. So this is a really good interview. You can go and see it on YouTube that Elon Musk did with Ron Barron at the end of last year. And he was actually asked by somebody in the audience why anybody should buy Tesla on a 50 PE when they can buy a BM or a Mercedes or a VW on a sort of a 10 type of PE. And he said, look, he's not going to talk to the share price. Everybody has to go and do their own numbers. But he did make some of these comments which are pretty compelling. And he was just saying that autonomy, and that's really the idea where, you drive a car that either doesn't have a driver at all, or, you can at least just sit in the driver's seat and not actually touch the steering wheel. He was saying that this is just a huge technological breakthrough that is going to turn the world on its head. And the argument he was saying here is that if you take a conventional car, that's driven by a human, on average, you're driving that car sort of 10 to 12 hours a week, a couple of hours a day. But with autonomous cars, you can pretty easily get that to 50 or 60 hours a week. And the question then is, how much more would somebody be willing to pay for a car that can drive 50 to 60 hours a week, bearing in mind that these cars are way cheaper to run on a per kilometer basis as well than an ICE vehicle, versus what you would pay for a conventional car. And effectively, what you would be paying for there is for the software. And we know how profitable software companies are, or many of them are. So that really becomes huge, where maybe somebody's willing to pay double for an autonomy-enabled car versus a conventional vehicle. But how you do the maths behind that is a little bit more tricky. Now, the problem with autonomous driving is that the perceived risk is significantly higher than a human driving. In the court of public opinion, the death of a family where a car has been driven autonomously and suddenly the accelerator gets flawed and it piles into a bridge somewhere is just multiples higher than all the accidents we see on a daily basis, even though statistically you can prove that it is safer to drive in an autonomous vehicle than the average. So how that left-hand chart works is the higher the column, the safer the car is. So the little gray columns is the number of miles, millions of miles driven per accident in a conventional car. The lighter blue column is the number of miles driven in a Tesla, not using their sort of autopilot technology. And then the blue columns is where they've got the beta versions of this driving around. How much safer is it? And they can show that even like for like, just with a Tesla, it is significantly safer having autonomous driving than a conventional driver. But what makes this so difficult and what makes this sort of so risky in the court of public opinion is exactly what makes it worth so much to the one or two or maybe three companies that one day do actually get legally approved for autonomous driving. And, when you listen to the talks given by the experts on autonomous driving, what they will say is that there is no ways that the world will ever legalize more than 3 or 4 different systems. And Tesla are light years ahead of the rest of the market on this. If there's only one company in the world that will ever be legalized for this, it will be Tesla. What you can't have is a situation where there's 20 different systems on the road, where you get to an intersection and the Volvo system is trying to interact with the Tesla system, with the BM, with the Mercedes system. So it's going to be more a software type of margin, and it's going to be a winner takes all. Whereas, Elon Musk said in his quote on the earlier slide that, no one is even remotely close to Tesla on this. Tesla themselves say they think that when they get to 6 million miles of test driving, that they believe they'll get regulatory approval for FSD or full self-driving. And they should achieve that level at some point in 2024. So, this is an exciting part of Tesla, and it's certainly one of the things that sets it apart from a lot of the conventional manufacturers out there. And then on Tesla, you get a whole lot of the other non-sort of automotive stuff too, that gives a lot of optionality to the business. The fact that you have these massive sort of storage factories of battery that they're building, obviously very sort of environmentally friendly with the big, solar charging panels and that. And that certainly over time, adds, some value to the business. Where they can then compete with the more sort of conventional, electricity generation facilities. And if we just look at these non-automotive margins, which have been running at a loss for a few years. For the first time in 2022, it's not making huge money yet, but things are trending in the right direction, and it has actually become profitable for the first time. Just looking at Tesla, I mean, obviously the current multiples are high. As we go out in the years and earnings grow, the PE multiple at today's share price does start to fall. Just bearing in mind that, the Tesla share price has been all over the show over the last couple of years. It's today about half of where it peaked, 18 months ago. And then it had fallen about 75% by the end of December. That's a bit of a tricky one because it halved in the month of December and then kind of doubled from its low again in January. So there was a very short window in early January where the stock was only on about a 20p forward to 2025. Obviously, that opportunity has come and gone like a ship in the night. But where it is today at 185, it's not as cheap as it was in January, but at least it's still well below where it was north of $400 a share 12, 18 months ago. So, it's certainly a bit cheaper than it was at its peak. Just looking at Morgan Stanley's sum of the parts and what they do, and bear in mind that the share is trading at about $185 a share at the moment. They've got a buy on it and they get to about $220 a share by adding up these various parts. They do very good work on Tesla. And what they show on their numbers is that they can get to about $117 a share just on the core auto business. And that's where Tesla, with the benefit, obviously, of hindsight, was kind of a slam dunk earlier this year, where when it was just north of $100 a share, you could buy it just for the core auto business without having to worry about putting a value on all of these other parts. You were kind of getting that upside for free. It's obviously a little bit less of a factor at 185, but there probably is still, some value there. One of the interesting things they show here is that they put a value of $9 a share on what they call mobility. And this is the whole sort of robo-taxi, autonomous driving, issue that Tesla are looking at. And the argument goes here that if you buy a vehicle that is fully licensed for autonomous driving, I mean, this is a little bit futuristic, but you come to work in the morning, your car drives you to work, you push a button, your car then gets released for the day into the Tesla robo-taxi pool. It gets driven around for the day. It actually makes a lot of money, some for Tesla, some for you as the owner as well. You recall your car at 5 o'clock in the afternoon, it comes back to the office and it takes you home. Now, if you look at Uber, for example, they charge on average maybe about $2 a mile. Uber, as the operator of that, gets about 25% of that. The other 75% goes to the driver. Now, obviously, the driver has to pay their salary out of that. That falls away with the robo-taxi. You're not having to pay a driver at all anymore. There's also the running costs, which at the moment the driver has to recoup, given that they're probably not driving an EV and more likely to be an ICE for now. That's obviously a lot higher. And then the key thing then becomes about just getting, the upfront price of the vehicle down. But you can see how that, a Tesla robo-taxi over time could be, huge competition to something like Uber. Maybe Uber can get involved as well. But, that certainly offers, some upside as well. So almost at the end of the presentation, there are other parts of Tesla as well that adds optionality like robotics. And they're just showing, for example, again, some ARC numbers on the left, where they suggest that robots have become so much more functional over the last few years that they've actually surpassed human beings for the first time in the last year. Remember, robotics is not just, a thing that looks like a human with arms and legs that runs around, but it's even these things like they have in Asia, for example, where if somebody's illegally parked, this flat device just goes underneath the car. It just goes under the four wheels, lifts it up a couple of centimeters. The wheels turn sideways. It just neatly extricates the car from the parking and off it goes. So again, these things are sort of hard to value, but there's just so much optionality in a business like Tesla that you don't get, for example, in a conventional manufacturer. So really, there's the conclusion and final slide. And what we sort of said is that Tesla really is a Kool-Aid stock. It's just one of those shares where you either drink the Kool-Aid or you don't. It's an every person for themselves type of stock. It's not a stock that you can shove down somebody's throat and say, well, you have to buy this, it will make money. You need to know what you're letting yourself in for when you buy a share like this. You've got to know that there's a lot of blue sky optionality that's been valued in for the very long term. You can't beat yourself up as this thing swings from quarter to quarter. And you've just got to have a very long-term view and tuck it away, and knowing that you're paying a rich price for this, that, there's no valuation underpin if something goes wrong with this business. And just the conclusion there really is the bulls do believe, and there's a strong case to be made for this, that Tesla will become the biggest market cap company in the world in the coming years. I mean, Apple is currently about 4 times bigger than them, so it would involve surpassing Apple. But the bears just say that this is an overvalued auto manufacturer, kind of just masquerading as a tech stock, and it's going to get caught out at some point. And in the end, we're going to find out that this is just a conventional auto manufacturer that should be trading on a single digit PE. And that's the conclusion. Happy to take any questions, Pete.
Fantastic, James. I think you'll all agree that it was absolutely fascinating. I think I've learned more about EV from James and reading lots and lots of big investment bank reports over the course of the last while. This has been a very well-attended webinar, approaching 450 people who've logged on, so a lot of interest in it. James, there are a few questions that I'm going to pose to you.
Yeah.
I'm going to try and basket them a little. So one is around hydrogen fueled vehicles. I think in the context of SA, the platinum companies are talking about hydrogen fueled vehicles as part of the future. Is that a better alternative for SA? People also asking about hydrogen in the context of gases. Yeah.
Sorry, Pete?
Yeah, sorry, Karen.
Okay. Yeah, so I was going to say it's a little bit of a mixed bag. I mean, there are some advantages to the hydrogen fuel cells. The vehicles are lighter. You have a longer range. It's travel range. So for range anxiety, in a country where you've got longer distances, it has that advantage. And also the refueling is quicker as well, more like I guess you could say like a petrol car. There are some things against it. One of the things I would say just is the network effect, which is, everybody's now looking at buying EVs because everybody else is looking, and they're starting to see charge stations popped up everywhere, and Tesla's all over the news, and all the conventional manufacturers are also trying to come out with the EV offerings and that. So, I'm not saying it's an impossible mountain to climb, but, you've already got EVs that have just stolen such a march on fuel cells. And there's already that network effect that has actually built in as well. Also, my understanding is that it does use a lot of energy to generate the hydrogen for fuel cells as well. And there's just one other factor that I was going to mention. It will come to mind now. There's just one other disadvantage as well. I'll think of it now.
Jazz, maybe just on that. So there's a few questions surrounding carbon audits and harmful emissions, and the fact that, the creation of electricity consumes, has a big carbon footprint. So carbon audits over the life of an EV versus an ICE, and, whether it, again, that's kind of part of the Kool-Aid, or it's a reality in terms of the new carbon-free future.
Yeah, look, on that, Pete, I don't think anybody's got a definitive answer. It's a very, very complicated topic. There's many assumptions and that kind of thing that have to be made. And what I would say is that obviously there's no free lunch. There's absolutely no slam dunk. But here would be my thoughts. I mean, the one thing is, if you drive an EV, it is just a nice feeling that at least you're not putting pollution in the town around you. If everybody was suddenly driving EVs tomorrow, at least the air in and around the cities and schools and that kind of thing would clean up significantly. You are obviously pushing that pollution somewhere else. So in the very long run, that doesn't really help. But, if the numbers are correct, that an EV is just so much more efficient transfer of energy into go forward energy in the car, then it must stand to reason then that although there is some pollution associated with an EV at the power station out in the country, and again, it depends, whether that's solar or wind or coal or nuclear. As I said up front, there's just so many complexities in working out that equation. But if it is just a so much more efficient transfer of energy, then it must stand to reason that on balance, an EV is somewhat less polluting than an internal combustion engine. And then there is that one other vexed issue that's maybe a little bit against the EVs again, is that there's a much wider range of raw materials that goes into making an EV than an ICE. And so maybe the mining environmental impact is a bit worse for EVs than ICE. But to bring it down just to one definitive number is hard. My personal opinion is that the EV is better than ICE, but it's not a free ride.
Okay, then in terms of the global production and competitors, BYD in China is often viewed, and I think they've got more market share than Tesla in China.
In China,
how do we view that
yes,
relative to Tesla?
Yeah, so look, a lot of people like BYD as well. In fact, Elon Musk himself probably views BYD as his single biggest competition. So my personal view is that the competition to Tesla is more likely to come from sort of almost new, native from the ground up EV manufacturers, a little bit like Apple came in with no experience and absolutely killed the conventional phone manufacturers. I think it's going to be the same in the EV market. So there's a couple of things to bear in, and I think BYD are absolutely at the forefront as well. I haven't looked closely at BYD's valuations, but I think they're trading on about a 30 PE as well. Remember that they did used to make ICE vehicles as well, and then they did hybrids and that as well. But as of a year ago, they actually ceased production of all internal combustion engines. So they really are a standalone, EV manufacturer. Obviously, they produce a lot of sort of cheaper cars than Tesla as well. So, Tesla is not going to have 100% market share. I don't think anybody, can argue that. But I think the competition will come more from like a BYD. One of the questions then is, will these conventional, ICE manufacturers transition successfully to EV? And I'm a little bit skeptical on that. So I think initially there's some novelty value to, let's say, a guy who's driven a BM or a Merc his whole life, he really likes it, and suddenly now BM comes out with an EV. There's some novelty value, or let me go and try that. But remember that your target market for Tesla and BYD and that is going to be Gen Z. In other words, the people born after about 1996. And ironically with them, Tesla is their number one held share in their stock portfolios. So that generation doesn't have the history with these ICE manufacturers like we do. They're just going to go straight to Tesla. And remember that getting the price down, you need scale. And these sort of small niche guys, everybody's got a couple of 100,000 EVs that they're making. I think a lot of them, when it really comes to scale and price and profitability, in 5 or 10 years' time are really going to be struggling. So I do think one or two will transition as competition to Tesla. But yes, it's probably going to be more the BYDs of this world that really are going to be competing head on with Tesla.
And then, James, do you see the availability of raw materials for EVs and associated mining as a realistic constraint on full EV displacement of ICE vehicles?
Look, I think to some extent it probably does. I mean, as we've always observed with these things, when you're doing things on a small scale as kind of a pet project, it's a lot easier to do. When you start doing it on a mass scale, then, the world does find a way ultimately to find a way around these things. How often haven't we said we're at peak oil and then the world finds more? Same with a lot of other raw materials. So I think in the end, the world will find a way to muddle through. But yes, when you start getting to mass scale, there could be a point at which there does come a constraint. And even the supply of electricity becomes a constraint as well. I mean, if we just take South Africa, if every ICE vehicle on the road got converted to an EV, clearly Eskom is already in trouble. There would be even bigger trouble. And, we've seen situations in California where, there's actually at times requests asking people please not to charge the EVs because they're putting a strain on the grid. So, this is a many, many year, slow, steady process. There are constraints in doing this transition too quickly.
Okay, I think we've run over our time. I apologize. Sure. There's heaps of questions coming through. I think I've tried to bucket them together and basket them together, and we can't get through all of it. There's also been, James, lots of praise for your presentation, so thank you very much.
Hey, thanks, everyone.
If you want a copy of it, your contact person at Anchor, it's been sent out to everybody. They can send it through to you, and yes, it will be available. It will be available on YouTube and the internet. So thank you very much. It was a delight to communicate what I think is a fascinating topic to all of you. And thanks a lot and have a good day.
Great. Thanks, everyone.